Welcome to this deep dive into Wells Fargo's uh, first quarter 2025 results. We've got quite a stack of material here: the official release, some earnings call analysis from the Motley Fool, Guru Focus highlights, and an Investopedia piece, too.
Exactly. And the idea here for you, the learner, is to really get the core story out of all this. We've waded through it to pull out the important stuff.
Right, so we'll hit the financials,
Yeah.
check on their progress with those regulatory issues, and see what they're saying about the rest of 2025, all based on what you gave us.
Let's do it.
Okay, so starting with the big numbers. Diluted earnings per share up 16% year over year. That sounds pretty solid.
It is, yeah. Net income was $4.9 billion, or 1.39 per share. So that, bottom line, definitely a positive signal.
But total revenue was actually down compared to last year.
That's right. And specifically, net interest income NII also dipped compared to Q1 24. That's, the money they make on loans primarily.
Okay, and Wells Fargo said lower interest rates were the main culprit there.
Yeah, that was their explanation. They did mention lower deposit costs and actually higher deposit balances helped cushion that a bit.
But analysts were expecting a little more on the NII front, weren't they?
Yeah.
Investopedia flagged that.
They did. It shows how sensitive banks are to rate movements. Even with some offsets, missing expectations suggests those lower rates really packed a punch.
So the core lending income was a bit soft, but non-interest income held steady. How did that break down?
Right. It was a bit of a mixed bag there. They had a gain from selling a servicing business.
Okay.
And wealth management fees were up, probably helped by good market performance. Investment banking fees were higher, too.
But not all good news on that side.
No, exactly. Venture capital returns were lower. They took some losses, selling off debt securities as they, shuffled the portfolio.
Repositioning.
Yeah. And trading gains were down, too. So it kind of balanced out to being stable overall, but lots of moving parts underneath.
Okay, so revenue's down, NII's down, but earnings per share are up 16%. How'd they pull that off?
Well, a big piece of the puzzle is expenses. Non-interest expense was down 3% year over year.
Okay. Cost control.
Definitely. Lower operating losses helped, and those efficiency initiatives they keep talking about seem to be, kicking in.
Even though they spent more on branches and people for them.
Right. That's the interesting part. They cut costs overall despite investing more in the branch network. It shows a real focus on finding savings elsewhere.
That is an interesting balance. We also saw a return on allocated capital at 11.4% and an efficiency ratio of 57%. What should we make of those?
So 11.4% ROAC is, reasonably profitable, shows they're getting a decent return on the capital they're using.
And the efficiency ratio, 57%.
That means they spent 57 cents for every dollar of revenue they brought in. Lower is generally better.
Right.
And while it's worth noting that ratio was actually lower in Q1 of last year and even lower in Q4 24. So while they're focused on efficiency, those branch investments are pushing that number up a bit right now.
Something to watch then, that trade-off. Okay, let's shift to the CEO commentary. Charlie Scharf sounded pretty upbeat overall.
He did, yeah. Highlighted the solid results, pointed to that fee revenue growth we talked about, the expense discipline, better credit results, too.
And he mentioned share buybacks helping the EPS.
Right. They reduced the number of shares outstanding by 8% through capital returns. Fewer shares means higher earnings per share. Simple math, but effective.
A big theme was progress on the risk and control front. That's been hanging over them for ages.
Absolutely crucial. Scharf made a point of saying they closed 5 consent orders just in Q1.
5, wow.
Yeah, brings the total to 11 closed since 2019. He framed it as completing a lot of the foundational risk work needed for the other orders. He sounded pretty confident about getting the rest done, too.
And getting those closed is key for eventually lifting that asset cap, right?
It's certainly a major step. It shows regulators they're serious and making tangible progress on fixing the underlying issues. That's critical for rebuilding trust and, yes, eventually getting that growth restriction removed.
Did he comment much on the broader economy?
Yeah, he sounded pretty positive there, too. Said the U.S. economy is holding up, consumer spending on cards is growing steadily, and credit performance is stable for both consumers and businesses.
And commercial real estate. Any change in tone there?
Nope. Said views were consistent with last quarter, so no new alarm bells ringing in that specific area, it seems.
It sounds like their bets in certain areas are paying off. Credit cards, investment banking.
That was the message. Investments in cards, IB, and trading are performing well. Connects back to those non-interest income bits we saw earlier.
Right. And physically, they're shrinking the branch network, but upgrading what's left.
Exactly. 6% fewer branches than last year, but they're speeding up the renovations on the ones they're keeping.
And pushing digital hard.
Very hard. Mobile app improvements driving usage, over 30 million active mobile customers now. It's a clear strategy. Leaner physical footprint, stronger digital channels.
Okay, let's circle back to that net interest income. What's the outlook for the full year 2025?
So, according to Guru Focus's summary, they expect full-year NII to be roughly 1% to 3% higher than 2024's total.
Oh, okay. So they see things improving from that Q1 dip.
Seems so. They expect some recovery as the year goes on.
Did they give more detail on why Q1 NII was down? We mentioned lower rates.
Yeah, the release broke it down further. Lower rates on floating assets, sure, but also deposit mix shifts and pricing changes, lower overall loan balances, and even just, one fewer day in the quarter.
The calendar effect.
Right. Partially offset by lower market funding costs, but still a collection of headwinds.
And the CFO, Mike Santomassimo, added some color on the earnings call.
He did. He talked about the uncertainty around interest rates. So the short end, like Fed funds, is kind of tracking their expectations, but longer-term rates are lower than they thought. And he mentioned loan growth is expected more in the back half of the year. Deposits are a mixed bag, some good retention, but still variable. So NII could bounce around a bit quarter to quarter.
What about deposit pricing? Is it still really competitive?
Seems like it, especially on the commercial side. He said pricing there is tight, not much movement, and likely won't be until the Fed actually starts cutting rates.
And consumer deposits.
More stable pricing, he said, but they're still seeing that slow drift, people moving money from checking into CDs or higher yield savings. Though he did say the pace of that shift has slowed down.
Okay. And their forecast assumes the Fed will cut rates this year.
Yes. Their baseline includes about 3 rate cuts in 2025. If that changes, obviously their NII outlook could change too.
Right, that makes sense. Okay, let's pivot to the loan book. How's credit quality looking?
Average loans were pretty stable year over year, around $224 billion. Not huge growth, but stable.
And charge-offs, loans they actually had to write off.
Good news there, mostly. Commercial net charge-offs decreased, and that was really driven by a big drop in losses from commercial real estate, especially office loans.
Oh, interesting. Office CRE has been a worry spot.
Exactly, so that's a positive sign. On the consumer side, charge-offs were down slightly overall. Auto and other loans improved, but credit card charge-offs ticked up a bit.
But they said that was seasonal.
Yeah, they flagged it as expected seasonality, so the overall picture for charge-offs was better.
Got it. And the ratio itself improved.
It did. The net charge-off ratio dropped to 0.45% of average loans. That's better than both Q1 last year and Q4 last year. So fewer loans going bad, proportionally.
What about the money they set aside for potential future losses, the allowance?
That stood at $14.5 billion, which is about 1.59% of total loans. It actually came down slightly from previous quarters.
So they're feeling a little less worried about future losses.
Seems that way based on that number. However,
There's always a however.
well, non-performing assets loans not paying interest did edge up a bit, mostly driven by commercial and industrial loans.
Not CRE.
Interestingly, overall CRE non-accruals were up just slightly, but within that, the office loan non-accruals actually decreased. So again, a bit nuanced within CRE.
And how does their reserve, their allowance, factor in the economy? Are they building in a buffer for tougher times?
Yes, they mentioned the allowance reflects a modest adjustment for potential economic weakness. It's based on a pretty significant downside scenario they model, one with higher unemployment, like 5.8%.
Okay.
And they also add some judgment-based overlays on top of what the model spit out. So they are trying to be cautious.
And back to those credit card charge-offs being up anymore on why? Just seasonality.
They said it was expected, yeah. Tied to the maturation of newer accounts they brought on during recent product pushes and growth efforts. Importantly, they stressed the quality of those new accounts remains strong.
Right, so it's not like they lowered standards, it's just the normal life cycle of new borrowers.
That's the narrative, yes. More volume leading to slightly higher but expected charge-offs initially.
Okay. Let's talk capital and liquidity, always key for banks. How is their CET1 ratio?
Common Equity Tier 1 was 11.1%. Stable with the end of last year, but down just a tick from Q1 2024 when it was 11.3%.
And CET1 is basically their core capital buffer against risks, right?
Exactly. Core equity versus risk-weighted assets, a key measure of financial strength.
What helped keep it stable this quarter despite being down year over year?
Lower interest rates actually gave it a little boost. It increased something called accumulated other comprehensive income, or AOCI. Basically, some of their assets increased in value on paper due to lower rates, which flows through to that capital calculation.
Interesting how rates cut both ways, hurting NII but helping that capital ratio.
It's complex, yeah. And they were busy returning capital, too.
Right, the buybacks and dividends.
Yep, $3.5 billion in stock repurchases in Q1, plus the 0.40 cents per share dividend. And Scharf signaled they expect buybacks to be higher in 2025 overall compared to 2024.
So continuing to send cash back to shareholders, how about other buffers, TLAC and LCR?
Both look strong. Total loss absorbing capacity ratio at 25.1%, well above the minimum, and the liquidity coverage ratio at 125%, also comfortably exceeding requirements.
So plenty of capital and readily available cash.
That's the picture, yes. They have significant excess capital above what's required, and they plan to keep returning a good chunk of it.
Okay, shifting gears a bit. Investment banking and trading areas they want to grow in.
Definitely. Scharf was quite clear they see big opportunities to gain market share in investment banking. He specifically mentioned equity markets as an area where they've been, historically underrepresented compared to peers.
And they're investing to capture that.
Yeah, putting money into talent, into technology in that corporate and investment banking division.
How did those businesses actually do in Q1?
Trading had a strong quarter. The CFO suggested market volatility might have helped there.
Makes sense. More volatility, more trading.
Potentially, yeah. But he also cautioned about seasonality in trading, so Q1 might not represent the whole year. Investment banking fees were up too, driven by more activity in debt capital markets on the commercial side.
Okay, and now the regulatory front. Always a big topic for Wells Fargo.
Well, closing those 5 consent orders in Q1 is undeniably significant progress. It's tangible movement.
And Scharf thinks the regulators will view this positively.
That was his stated belief, yes. That the current administration will react well to their continued work on the remaining orders.
What about the asset cap itself? Any hints on timing?
No timeline given. Scharf called it a reputational overhang.
Yeah.
He stressed they've managed to operate well below the cap,
Right.
but he acknowledged lifting it would open up growth opportunities where they've been held back, maybe consciously or unconsciously, things like trading, expanding product sets.
But the focus now is just getting the work done.
Absolutely. It was clear. They'll spend whatever it takes to complete the risk and control remediation for the open orders. No focus on cutting costs in those areas right now. It's about getting it right.
Makes sense. And lastly, just a quick word on deposits. We mentioned the mix shift.
Yeah, those non-interest-bearing deposits, the free funding essentially, are down to about 26% of the total.
Is there a natural floor for that?
The CFO said the long-term level really depends on where interest rates eventually settle and how customers behave. He does expect deposit betas, how quickly their deposit costs react to market rates, to kind of flatten out as the mix stabilizes more.
Okay, so wrapping this all up, it feels like a pretty mixed quarter for Wells Fargo.
That's a fair summary, I think. You've got that strong EPS growth. You've got real visible progress on the regulatory front. Those are
Right.
big positives. But yeah, revenue headwinds, especially at the NII pressure, are real. And the asset cap is still there, limiting certain growth avenues. It's complex.
And the earnings call discussions really highlight those dynamics, how sensitive NII is to rates, the hopes for loan growth later this year, the eventual upside if that cap gets lifted.
Exactly. It gives you a sense of the key levers and uncertainties they're dealing with.
So for you, the learner, listening to this, what really stands out? Is it the regulatory angle and what happens next there? Or maybe the puzzle of managing NII in this environment? Or perhaps their push into investment banking?
Yeah, hopefully this deep dive gives you a solid base. From here, you could, look at detailed analyst reports for forecasts, or just keep tracking the earnings each quarter to see how these stories unfold. Lots to follow.